I'm Mark Robinson, the CEE Research Specialist at Colliers International. The outlook for the CEE region, I'll start off with the bad news. The bad news is on the left-hand side chart. The light blue line on that left-hand side chart is the European investment flows that we've seen every half year for the last cycle. So you see the drop-off through 2007, 2008, then the rise through the cycle. It peaked in the first half of 2015 and is now falling. Now, events, of course, like Brexit have exacerbated that fall, but the point is that the cycle had peaked already and it's on its way down. So there's a bit of an issue in Western Europe. There's a bit of an issue for us in Central and Eastern Europe, because the dark blue line is the Central and Eastern European investment, and you can see it tracks the Western European investment to a certain extent. And at the moment, we're still rising, which is great. Great news for all of us in this room. But how long can we sustain that if the Western European cycle is subsiding to a certain extent? Now, obviously, there might be factors that mitigate that fall in Western Europe, but who knows? Anyway, that's the bad news. The good news is our share of mind is going up. So on the right-hand side is the proportion, the percentage of the total investment that we've had in Europe each half year that's come into Central and Eastern Europe. So our share of mind is growing, is ever growing. It's now over 6% of all investment in the whole of Europe is coming to the Central and Eastern European region. And when I say CEE in this presentation, I'm talking about the Visegrad 4 countries plus Romania and Bulgaria. So increased share of mind. We've got a responsibility to keep that going. But it's a very interesting dynamic. Drilling down a little bit on the right-hand side, this chart got the last year's volume of 12 billion euros divided up between the countries. Obviously Hungary there at 1.7 billion euros, which was a record high in this cycle. So on the left-hand side chart, I put the specific investment volumes into Hungary that we've seen over the last cycle, and you can see that peak, the peak, and the rapid improvement from the significant trough that we saw in 2012, 2013. Now, there was obviously reasons for that, and also we saw those reasons unfolding in the wider capital markets in Hungary, in the bond markets and the equity markets as well. People were very worried about the governmental situation in Hungary 3, 4, 5 years ago. What I'd say is that Hungary has now come through that fire to a certain extent. I know this, I've been active in the equity markets and know the Hungarian equity market very well for 20 years. We've come through that fire in terms of people understanding the risk of the Fidesz government and pricing that risk appropriately. And you can see now that investors are much more used to this new environment. Now, in certain other countries, even in Central and Eastern Europe, we've now got heightened more significant political uncertainty. So, for example, particularly in Poland at this stage, Bulgaria now to a certain extent, we've got some political uncertainty to deal with in those countries. And obviously, if we look at Western Europe, in 2017, we got the French election, the French presidential election, we've got the German elections, we've got the Dutch election coming up in 3 weeks' time. So there's a lot of uncertainty in terms of politics that we need to think about in terms of the investment climate. And obviously, we can maybe call this, in its broadest global sense, let's call it Trumpism. We don't know what Mr. Trump's going to do next week, let alone in a year's time. But this phenomenon is something which we have to deal with now. My point here is that Hungary has gone through this already. We've seen what I've called domestication of investment in Hungary. So I've got here the origin of investments in 2014, which was around 600 million euros, and the 1.7 billion euros last year, where that money came from. Just to show some differentiation. The money that's come from within Hungary itself is pretty consistent, around nearly 40% of the total investment that's been committed to the real estate market in this country. But what's interesting is that the composition from elsewhere has changed. So if we look at 2016, we've seen the rise of US investment from around 10% of a smaller pie, smaller total amount in 2014 to 16% in 2016 of a bigger pie. So American inward flow has been quite significant over the last year or two. Austria, next, the third biggest, followed by Germany. So significant money coming into Hungary. in the last couple of years from those destinations. So this is quite interesting dynamics that we're seeing in the Hungarian market. We've also got Slovakia and Greece also as origins as well, that are appearing on the radar screen in 2016. So quite interesting dynamics there. Now that's what's happened. Now a little bit on why, and maybe what's going to happen in the future, which is obviously crucial to all of us. Got here the leading indicator that many people follow in terms of the German economy. This is the IFO Institute in Munich's monthly sentiment survey. And this is a pretty reliable indicator for stock markets and many economic indicators. And what we've got, the light blue line, is that German IFO indicator lagged by 4 months. So I pushed it back 4 months in time, and I've put against it the composite sentiment indicator, so a monthly leading indicator itself in the CEE 6 countries, bound together and looking at the sentiment across the economies. So this is a real general barometer of economic optimism or pessimism in the Central and Eastern European region. You can see that German IFO index is leading the composite sentiment indicator, the dark blue line on that chart. And that sentiment indicator, you can see the dark blue line is rising, and is moving towards cyclical peaks. So this looks quite positive, and I can tell you actually 15 minutes ago the latest German IFO figure came out above expectations. So that light blue line is on the rise again, which is good news for our region. If we take a sub-segment of that composite sentiment indicator, the light blue line on this chart, this is the consumer element of that series. So again, taking the CEE 6 countries. And what I've done in this chart is lagged it by 18 months, so pushed it back through time. So those dots for the light blue line on the right-hand side have already happened. That's data that's already happened. What it's suggesting is that dark blue line, which is again our investment flow into the CEE region, looks as if it's got pretty good foundation for the next 18 months or so. Fingers crossed. But we'll have to see whether we can withstand the European downturn. But this chart suggests that we've got some optimism in terms of likely total amounts of investment continuing to rise rather than fall. So this looks like a pretty good story at this point if we look at these major economic indicators. What's the result? The result has been a compression in yields. We've got the 18 key core yields in the 6 countries, the 3 key sectors, office, industrial, retail here, retail, traditional shopping centre. And we've seen compression over the last 12 months. The ones that are circled, so 6 of those 18 even compressed in the 4th quarter of 2016 versus the 3rd quarter. So continuing compression going on. Us at Colliers, for the next 12 months, we think out of those 18, we think 9 of those 18 are going to continue to compress. So that gives you an idea of where we think the yields are going, particularly places like Bucharest. We see compression in all 3 of the categories. So that money flow that I've already shown you that's likely to rise, it's the likely result, if we're left alone, let's say, if the rest of the world doesn't affect us, we are likely to see some further compression in yields across the CEE region. But what's the threat? The biggest threat is a global phenomenon, which is the rise of inflation and the rise in bond yields as a consequence of rising inflation. This phenomenon started last summer in global capital markets. It accelerated with the election of Mr. Trump, because Mr. Trump has come out and said, I'm going to do a huge fiscal stimulus, and the US bond market said, inflation, we have to price that in, and bond yields in the US went up. So the right-hand side chart shows you the US bond yield movement since the 31st of October, just before the election. We've added 67 basis points on the US 10-year yield. It's quite significant. This is the world's risk-free rate. We've added 67 basis points in a very short amount of time. So, what's happened in the region? similar movements in Poland, Hungary, Romania. You see almost exactly mirroring the movement in the US. So the higher that US 10-year yield goes, the likely higher the bond yields in the key CEE countries go. And this therefore translates into the biggest risk for us over the next year or two in terms of investment flow and in terms of what we might face in terms of risks. But fortunately, we've got a cushion. What I've done here on these charts is taken the funding yield gap. So I've taken the blended average of the key real estate yields in the capital cities that I showed you on a couple of slides ago. So for example, in Hungary, it's around 7%, that yield. Office, industrial, TSC retail, average 7%, roughly. And then subtracted the 10-year bond yield as a proxy. And that looked at that back through time. And one can see then that this funding yield gap is very wide in all of the countries presently, compared with the past. So Budapest, very wide. So it's nearly 4%, 3.5%, 4%, with that blended property yield around 7%, the 10-year bond yield around 3.5%, 7.5 minus 3.5 is 3.5, which is what that dark blue line top right-hand side chart is showing. And you see the pattern's the same across the region in the key capital cities. And we've got these big premiums to the averages of the past. So we've got some cushion. So we can see bond yields rising, as I illustrated in the previous slide, without necessarily our real estate yields having to back up as a consequence. Now, this won't last forever, because if the 10-year bond yields keep going up, then these dark blue lines will fall. And therefore, we've got the problem. And therefore, at that point, the yields will stop falling. The real estate yields will stop falling, and then we'll then see some backing up pressure as a result. But we've got a cushion. What other inputs have we got to rents? Well, we got a very low unemployment rate across the Central and Eastern European region in general. Czech Republic's got the lowest in the EU at 4% on the left-hand side chart. Hungary there at 5%. So unemployment's very tight. Labour market's very tight. That's starting to contribute to inflation. And therefore, on the right-hand side, we've got the CE6 blended CPI forecast for 2017 at over 2% versus nothing, let's say, in aggregate in the previous 4 years. We've had almost deflation in Central and Eastern Europe over the last 4 years, and Hungary has obviously been one of those countries that's seen that. But it's suddenly changing. This picture is suddenly changing. Now, also specifically, the Eurozone CPI is also likely to be rising, because also there are wage pressures within Europe as a whole. And also this idea that the quantitative easing in Europe that's currently being executed by the ECB, that is going to continue in the face of this inflation rate rising. I cannot see that. We will see the ECB changing their tack very soon, in my opinion. If we have 2.5% inflation in Europe, this has an implication for benchmark rents across Central and Eastern Europe. And if it repeats next year and the year after, this is a positive, let's say, certainly for those landlords who have obviously got contracts that their tenants are paying rent linked to Eurozone CPI. So this is a major factor that we have to think about, and as I said, broadly positive for the landlords. But the wage risks are rising in general across the Visegrad region. We've seen wages basically double from 2005 to 2015 in the manufacturing sector in the Visegrad 4 countries. Now, this maybe has some advantage for Romania and Bulgaria relative to the Visegrad 4, in that their wage levels, Romania is around 600 euros per month at the moment. So they're more competitive at this point. So we may see some movement southeastwards, away from the Visegrad 4 into the SEE countries, Romania, Bulgaria, and the other Balkan countries. So there's dynamics within the region. But within Hungary, there is a clear and present problem I can see in the industrial sector. We've got here on the left-hand side chart, this is coming from Eurostat, the EU, Brussels, collecting data, the national data from the various countries from the industrial surveys every month and every quarter. The dark blue line is 1,500 Hungarian companies answering the question, do you have a shortage of labour problem that's limiting your ability to increase production? That is the question that's being asked in Hungarian obviously, to 1,500 Hungarian companies. And 70% are now saying yes to this question. This is off the scale. Look at the past. I mean, Hungary at the past, it peaked at 30, 40%. I can tell you the EU average is about 10. Okay? Poland and Czech also have similar sort of problems on that left-hand side chart, the red and the light blue lines. They have similar problems, but Hungary is off the scale. So there is a clear and present danger that wage growth in Hungary is going to be above 10% this year. So I know about the public sector wage rises that have been negotiated, and there's obviously strikes going on even at the Audi plant, even this week. The wage issue is live, and this is a risk. It's certainly a risk for the industrial sector, because wages have to stay competitive in order for Hungary's economy its export-led economy to stay competitive globally. It's a problem maybe for the BPO and SSE in the office arena, those companies. There's a problem there because obviously the labour there is getting more and more expensive, so well, let's go and locate in Moldova or Romania or Bulgaria or Serbia instead of these countries where the wages are increasing much more quickly. So this is an issue, this is a risk. It's less of a risk for the retail sector because the retail sector is actually a beneficiary because the workers who are getting the higher wages go and spend it, which is fantastic. Fantastic for them. So there's a big sectoral difference in terms of the effect. Positive for retail, negative possibly for office, SSE, BPO, and certainly, in my view, negative for industrial. Another risk that's out there in general to think about for the retail story, which at Colliers we're most bullish on amongst the sectors, is the idea that we're seeing greater amounts of shopping done online and not done on the high street, not done in shopping centres. Now, the UK is an outlier. Over 80% of consumers in the UK shop online, including my 68-year-old mother on her iPad. So I can vouch for this. But in Central and Eastern Europe, we've got a huge maybe catch-up potential to happen. But Hungary, 36%, so roughly 1/3 of Hungarians shop online, roughly. This was data from 2015, so it's growing quite fast, between 10 and 20% on the right-hand side chart. These are estimates from Statista. So it's growing at a faster rate than retail sales. Retail sales may be growing here and in Central and Eastern Europe between 5 and 10%. It's growing at roughly double the rate of retail sales. But it's a threat. It's a threat to think about in terms of the marginal shopping centre in that marginal region looking forward. We have to think about what the risks are. So then looking in general to finish up, what are the positives, what are the negatives for the region? On the positive side, this strong momentum, consumption-led GDP growth. As I mentioned, Germany's underpinning those export-led economies, in particular Hungary, Czech Republic especially. We've got firming rents, especially in the retail sector. We've got wage growth that's positive for the retail sector, but negative for BPO and SSE, as I mentioned, and the industrial sector. We've got fiscal expansion in most countries. We've had very tight fiscal policy in general. Czech Republic had a fiscal surplus last year, and now they're spending a bit more money finally, which is good news for the population. So there's fiscal expansion going on. We've got that inflation spike I mentioned that's going to add to the rental outlook for many operators in the region. Specifically in the Czech Republic, very likely to see the cap removed from the currency that's holding it down against the euro. That will very likely, in my opinion, to see a significant appreciation increase in the Czech crown level that has all sorts of implications for Czech real estate. And also, as I mentioned on the rate rises, the effect on the Central and Eastern European region is not immediate. the market is liquid enough, deep enough, there's enough money that's come in the past for this not to be immediately destabilizing, unless we have a crisis somewhere. On the risks, as mentioned, the inflation, interest rates, e-commerce, I've mentioned. Then some others, EU funding. EU funding has driven investment in the region over the last 2 cycles. It might dry up due to Brussels not liking the government in Poland, for example, having an argument with them. The only carrot, the only stick the EU Commission has against the Polish government is EU funding. So they might start using it. We never know. Then we've got this taxation risk. I've called it the Trump Brexit world. So the moves that we might already be seeing in the Polish situation as regards the real estate market is a risk. That's an uncertainty that's not yet cleared up, for example. And taxation, this Trump Brexit world, this is the idea that we may be seeing greater taxation of assets relative to taxation of labour. That it's the complaint of the Midwestern Americans who voted for Trump is that the rich 0.5% of society have got richer, the Wall Street's doubled and everything else, and us, we see nothing. So it's that generalised risk that we have to think about as people who are operating in an asset market. The real estate market is an asset market. And then finally, China debt instability. That's for me the biggest emerging market risk out there. And also what Trump might actually do. We'll have to see what he ends up doing, but he's pretty unpredictable at this point. So on that note, I'll leave it to the real experts. Thank you very much.